All right, good afternoon, and welcome to the Smith & Gesteland series of Web Connect webinars. My name is Neil Fauerbach. I'm a partner with Smith & Gesteland. For those of you who don't know us, S&G is a local CPA and business consulting firm. We're about 85 people strong at our office in Middleton. We have clients in manufacturing, supply chain, construction, high-tech, professional services, and nonprofits. We are particularly well known for our family business practice and our 80/20 services. And if you happen to be a family business, we also are the founding sponsor of the Family Business of the Year Award, which is accepting nominations right now. Check out our website. Today's topic is Business Valuation Demystified for Small Business Owners. Our presenter today is Theresa Zeidler-Shonat. Theresa specializes in business valuations at Smith & Gesteland, valuing the invested capital in a business, business equity, and intangible assets, depending on the client's needs. Theresa's valuations assist business owners with understanding the value of their business and what drives that value, as well as what differences exist between the way a business owner perceives their business and the way a potential buyer perceives the business, something she will get into today. As the webinar progresses, please type questions into your control panel. If we have time at the end, we'll attempt to answer them. We will be sending an email later this week answering your questions and providing additional information. So I will now hand it off to Theresa. Take it away.
Thank you, Neil. Thank you, Neil, and thank you all attendees. For any attorneys online, this webinar has been pre-approved for 1 hour of CLE, so you're getting a little bit of free CLE in the afternoon. So what is business valuation? You know, about a year ago, I went to a seminar in San Francisco that was hosted by the American Society of Appraisers. And it was a seminar that was designed to teach people to be good expert witnesses. And the guy standing up in front of the class talking about what makes a good expert witness said something to the room, which was a mixed bag of business appraisers and arts appraisers and machinery and equipment appraisers. And he said, "You business valuators, I really feel for you. When people talk about art, people understand what it is. When people talk about machinery, people have some idea what you're talking about. When you start talking about EBITDA multiples, people's eyes glaze over and they start wondering if they can get their Aunt Gertrude's green bean casserole recipe." So we're here today to talk about what business valuation is. Hopefully none of you are thinking about your Aunt Gertrude's green bean casserole recipe at the moment. So what is business valuation? The short answer is that business valuation is a process and a set of procedures used to estimate the economic value of an owner's interest in a business. But before we get to the long answer, and that's the reason I suspect you are here, let's do a quick poll question. There's a small typo in the poll. It should be what motivated you.
To confirm or acknowledge 60%.
That sounds pretty much like what we thought. So let's start with some terminology. I mentioned that I had been at a seminar presented by the American Society of Appraisers. So what's the difference between valuation and appraisal in a business context? Valuation is the act or process of determining the value of a business, business ownership interest, security, or intangible asset. Appraisal is the act or process of developing an opinion of value or an opinion of value. So as you can see, there really isn't much difference between the two, and in this context, they will be used interchangeably. So when do you need a valuation? That's the first question that people always ask me, and we'll touch on some of the more common times when you might need a valuation. One very common one in closely held businesses is estate and gifting situations. This can happen upon the death of a business owner or a business owner who wants to transfer ownership to the next generation through a gift of shares, or who potentially wants to donate an interest in their business to a charitable foundation. Another very common scenario in closely held businesses is that a party in the divorce holds an equity position in a closely held company or owns intellectual property that is considered part of the divisible marital property. Another common scenario are lending scenarios in which SBA loans require a business valuation if a specific set of conditions exist. Those conditions are typically a transfer of control and a loan-to-value ratio that meets a certain criteria. You can also occasionally see valuations done when intangible assets are being used as collateral and the lender wants an idea of their worth. For those of you who are forward-looking, business planning is a great time to do a business valuation. Business valuations can be used in strategic planning if your company is considering several options and wanting to determine the impact on your business of these scenarios. Business valuations can be done for succession planning, for the point at which you want to transition ownership to the next generation. They're great to do for exit planning if your exit is a transaction with a third party, not someone involved currently in the business. And business valuations are also very useful when you're assessing the impact of expanding into a new industry, product line, or making an acquisition. Business valuations are often required for financial reporting purposes. The most common one would be a purchase price allocation pursuant to ASC 805. In this case, the total purchase consideration is allocated to the acquired assets. This includes intangible asset valuations. You also see financial reporting valuations done for goodwill impairment testing. This happens when the company has goodwill, or what we call indefinite-lived intangible assets, on their balance sheet from a previous acquisition. Occasionally, if a company holds a minority interest in another company and is required to mark that investment to market, those interests are often valued as a minority interest in a business and put on the balance sheet that way. Additionally, valuations are crucial in certain cases related to stock-based compensation. 409A is the primary of these. Private companies are required by the IRS under Section 409A to show that their common stock options are issued at fair market value, and therefore the companies must conduct a formal valuation opinion at least once every 12 months to avoid potential tax penalties. It's important to note that the tax penalties that are avoided in this case are penalties your employees would pay, not you, the company, would pay. Additionally, ASC 718 requires that all equity awards granted to employees, consultants, and board members be accounted for at fair value and then expensed over the vesting term of the grant. This can become more difficult as additional grants are made and vesting and forfeitures add complexity to the calculations. Another scenario in which you might need a business valuation would be if you hold intangible assets or intellectual property and you're hoping to monetize them. Monetization of intangible assets can happen through use as a collateral or licensing the asset to a third party, a sale of the intangible asset, or if you're looking to purchase an asset and looking to help determine the fair price. Buy-sell agreements often have a provision for determining the price at which an interest in the company is sold. When you're developing a buy-sell agreement for your business, basing it on a valuation or requiring a periodic valuation as part of the buy-sell agreement mitigates risk to your company. Additionally, not all companies have a buy-sell agreement in place. If you have a shareholder buyout situation going on, a business valuation can provide a good point to begin negotiations and smooth the process. So we've been through all of that, and you say, hey, I'm going to need to do a business valuation. What happens next? Well, business valuation is a process, and the process has a number of fairly defined steps. The first step is what we would call the project scoping, in which you would have a discussion with a valuation professional to talk about what's going to be valued, when it needs to be done by, the definition of value, all of the pieces about the valuation, who you need it for, why you need it, and we would then issue an engagement letter that covers all of that scope. Once that engagement letter is signed, the valuation process can begin. The process begins with an information and data request. The information and data request can sometimes be lengthy. It'll be information such as historical financials for the past 5 years, any projected financials, anything that could impact the value of your business. It is designed to allow the valuator to learn your company, to become an expert in your company. So while it seems lengthy, it's also important. The duration of this step can depend on how quickly you, as a client, respond with the requested information. But once it's done, we can begin the initial modeling and industry research. The modeling and industry research can typically take 4 to 6 days to complete, assuming that all of the information is received that we need. Typically, though, we'll have follow-up questions. We'll see information that we'd like follow-up on in the modeling and research, or perhaps we've discovered that we've missed something that we asked for. So we will go back and ask for additional information. Sometimes this process happens multiple times. Once we have all of the information we need, we then finish the model and finalize the report. And this can take a few days to a week, depending on the responses received to the follow-up questions. Occasionally, we'll issue a draft report to allow you to ask questions and make comments before we finalize the report. And then the last step in the process is to submit a final report to you, the client. So all in, this process can typically take 3 to 6 weeks from start to finish, assuming good information flow, and we all know how life is and it interrupts you sometimes, so that can impact the time from start to final report. And here we have another poll question for you.
All right, we've got 67%. 70% have voted. 67% said the price a buyer is willing to pay. 15% said the relationship between a business and a buyer. And 14% said how much the owner thinks the business is worth. 5% said a good deal. Got a minute, we'll close that.
So, now that we have those answers, what is value? Value expresses an economic concept. As such, it is never a fact, but always an opinion of the worth of a property or asset. Value should always be qualified or described. For example, fair market value, liquidation value, investment value. The Uniform Standards of Professional Appraisal Practice define value as the monetary relationship between properties or assets and those who buy, sell, or use those properties. There are many things that we call definitions of value. These definitions of value describe what sort of value you are appraising. Fair market value, fair value, investment value, intrinsic value, liquidation value, and liquidation values can be either orderly or forced liquidation. The most common valuation definition of value for fair market value that you typically see in closely held businesses is the IRS definition. This comes from IRS Revenue Ruling 59-60, and it is the value definition that all estate and gifting valuations in the state of Wisconsin are done under. Additionally, all divorce valuations in the state of Wisconsin utilize this value definition. It is the price at which a property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the relevant facts. You also see court decisions which state that in addition, both the hypothetical buyer and seller are assumed to be able, as well as willing, to trade and to be well informed about the property and concerning the market for such property. There are other definitions of fair market value. They're similar. This one comes from the International Glossary of Business Valuation Terms. And it is the price expressed in terms of cash equivalents at which property would change hands between a hypothetical willing and able buyer and a hypothetical willing and able seller, acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or sell and when both have reasonable knowledge of the relevant facts. So as you can see, these definitions are very similar. They are willing and able buyer, willing and able seller, knowledge of the market, knowledge of the company. Fair value for financial reporting, which is what you will use in any sort of purchase price allocation, goodwill impairment, or ASC 718 valuation, is the price that we receive to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, this has some similarities to fair market value. That is, it's an orderly transaction between market participants, which is very common to that fair market value definition. However, it has one key difference. Fair value is an exit value, while fair market value is an entrance value. To illustrate why this makes a difference, we're going to step back for a minute and use something kind of concrete that you can picture. Imagine you're at an art auction and someone bids on a painting and buys it for $10 million. However, the next highest bid was only $9.5 million. In this case, the fair market value, which is the price paid to enter ownership of that painting, is $10 million. However, the fair value, which is the price that new owner would get were he to turn around and sell that painting in the next minute, is only $9.5 million. In the real world, in most cases, there's a very small difference between the two. Just to muddy waters a little bit, fair value can also be defined on a state-by-state basis in divorce matters. Not in Wisconsin, but in other states, fair value is sometimes the standard of value statutorily defined for divorce. So what's investment value? An investment value is the value to a particular investor based on individual investment requirements and expectations. This is often what owners, of closely held businesses view as the value of their business. It doesn't make it wrong, and in fact, it's probably quite right. However, it's also not fair market value. Individual investors can have very different expectations than the market, and this can cause some friction when talking about business valuation. So it's really important to understand to whom the value is. Who has that value that you're talking about? Is it an individual investor or is it the market? Intrinsic value is also interesting. It's the value that an investor considers on the basis of an evaluation or available facts to be the true or real value that will become the market value when other investors reach the same conclusion. That is, it's the value that people believe will be the company value when the market finally catches up to their thought process. Lastly, we'll look at liquidation value. Liquidation value is the most probable price that a specified interest in a property is likely to bring under extreme compulsion to sell. Now, that was paraphrased from the Appraisal Institute's Dictionary of Real Estate Appraisal, but you can have liquidation values on businesses, you can have liquidation values on tangible assets and on intangible assets. So we've talked about value definitions. Let's talk about what can be valued. When you're talking about a business, there's this thing called the business enterprise. The business enterprise, which is sometimes called invested capital, is the value of the equity and the value of all interest-bearing debt in the business, which is equivalent to the value of net working capital plus the value of tangible assets plus the value of intangible assets. Any of the components on this graph can be valued individually or together. Invested capital can be thought of as the price that you would receive if you were to sell the whole business today. That is, it's the value of the entire business. As I mentioned, it's equal to the value of the equity in the business plus the value of the debt. Equity is the value of the business available to any equity holders after debt service. That is, we all know that if you have debt, it's primary to any distributions or dividends that you're going to receive, or any monies that you'll receive out of the business in a sale. Equity can be valued as a 100% interest or as a fractional interest. That is a less than 100% position. There are also varying levels of value depending on what's being valued. There's the business enterprise value. There is a 100% equity value. You can have a non-controlling equity value. That can occur if you have less than a 50% ownership interest, for example, or if you have a 95% ownership interest, but it's all non-voting shares. You can also have a non-marketable equity value. This is the case for all privately held businesses. There is not a ready market in which you can liquidate your business. The comparison here would be to publicly traded companies where if you had an interest, you could sell it on the market within 24 hours. With a closely held company, if you were to sell the whole business, it takes 4 to 6 months to market as a short estimate. If you have a smaller interest in a business, it can take longer than that. Which gets us to a non-controlling, non-marketable equity value. Non-controlling, non-marketable equity values are just what that sounds like. Interests in privately held companies that are less than a control level. And to further confound things, we can also have non-marketable, non-controlling, non-voting interests. This happens if you have multiple classes of shares. We can also value intangible assets. We're not going to touch on those a whole lot this afternoon, but we will list the sorts of intangible assets that can be valued from monetization, or if you're curious. These include things like intellectual property, marketing intangibles like your trade name or logo, contract-based intangibles, typically things that generate a stream of revenues on a contractual basis, customer relationship-based intangibles. Your customer loyalty is an intangible in the business, or artistic intangibles like copyrights. Here's a question I'm often asked. Does when a valuation is done make a difference? The answer is an unequivocal yes. Valuation is a point-in-time measurement. I cannot stress this enough. Value changes over time, and what we call the valuation date, or the as-of date of the valuation, is very important to the value conclusion. Additionally, some valuations have date requirements or deadlines. For example, in estate tax, your valuation date is the date of death, and then you have a tax deadline as well. For financial reporting, typically your valuation date is fiscal year end. And like with many things, if you let too much time elapse between your valuation and your valuation date, gathering information can be a bit like an archaeological dig. The longer you let it go, the harder it is to gather information, the longer the process drags on. Here's another question I'm frequently asked. How much valuation do I need? And now, I'm sorry about this. If you guys have ever seen the PowerPoint video, Life After Death by PowerPoint, this is death by PowerPoint. However, I'm providing this information to you because we will be providing these slides as a download after the webinar, and this is a good reference for you. There are two types of valuations. There's opinions of value and calculations of value. The opinion of value is the full bells and whistles. It's the full valuation process, and it leads to an opinion of value. There's also something smaller called a calculation of value. And here's the primary difference. In a calculation of value, it's simply some agreed upon procedures that apply typical valuation methods that get to a calculated value. It does not result in an opinion of value. Why is this important? Well, as you can see in this graph, if you're looking for anything that will be accepted by courts, by the IRS, or as the basis for expert testimony, you definitely want an opinion of value. Additionally, because calculation of value uses limited procedures and doesn't do all of the research, the value conclusion could be different were you to go ahead and do all of the market research, look at the financial benchmarks, do a company-specific risk assessment or a macro risk assessment. So how is value determined? There are three approaches to value: the market approach, the asset approach, and the income approach. In any solid, supportable valuation, you want to see some combination of these, that is, more than one approach used to arrive at a value conclusion. In general, the conclusions from each of these approaches should arrive in a relatively tight range of each other. The first approach is the market approach. The market approach theory is predicated on the thought that the value of the company reflects the price at which comparable companies are purchased under similar circumstances. This approach requires that comparable transactions be available. So if you've got a company for which there are not many transactions, this approach may not work for you. There are two methods within the market approach. There's actually more. These are the two most common. The guideline publicly traded company method, and in this method, the value is based on multiples from similar and relevant comparable publicly traded companies. Because publicly traded companies are larger and better capitalized than privately held companies, typically, adjustments are often necessary to make the comparables more similar. There's also a comparative transaction method, which is based on actual transactions of similar entities. The public company method relies on information, as I said, from publicly traded companies. You should have more than one. You should have several, at least 4, 6, 8 companies as comparables. And again, adjustments may be necessary. And sometimes, and this is a key, it just doesn't make sense to use public companies. Sometimes the public companies are too dissimilar, and they don't provide a reliable and reasonable value indication for your company. The comparative transaction method relies on transaction database multiples. That is, there are a number of transaction databases out there that aggregate data on transactions in smaller privately held companies. You can also look at prior arm's length transactions in your company. You can also look at non-arm's length transactions, but they need to be viewed a little bit differently. You can consider them, but you can't rely on them because if they're not arm's length, it isn't a fair market value, assuming that's your value definition. I've listed rules of thumb here only to tell you never to use them. The only time it's appropriate to use a rule of thumb is if you are someone who buys and sells a lot of companies. A good example is someone who buys and sells a lot of, say, McDonald's franchises. If you've bought or sold 50 of them in the past year, you probably have a good idea of what the market multiple is. Otherwise, a rule of thumb is never a good place to start with a valuation multiple. As I noted, there's comparability issues. Public companies tend to be larger and have greater resources and access to capital, and the multiples need to be adjusted. With the private company transaction databases, we often don't have access to the terms of the transaction, which can impact price. Here again, it's important to have more than one item to compare your company to. The asset approach. The asset approach is predicated on the idea that the value of the company is estimated as a function of the current cost to purchase or replace all assets held within the operating entity. It's based on the principle of substitution, which states that no prudent investor would pay more for a company than the amount to recreate or buy it. The asset approach is useful for asset-intensive businesses, real estate holding companies, entities that hold mostly securities or cash, and some contracting businesses that bid for work. Some of the challenges of the asset appraisal, the asset approach, it often requires outside appraisals. The fair market value of your equipment, for example, is probably not equal to your book value of your equipment. You have to identify non-operating assets like excess cash or obsolete inventory. And your company may have intangible assets that contribute to business value that some market participant would pay for, but that aren't listed on the books. The income approach. The income approach is predicated upon the idea that the value of the future cash flows that an asset will generate over its remaining useful life are equal to the value of the business. It involves the projection of the cash flows of the company, and those cash flows are then converted into a present value equivalent through discounting. There are several income approach methods. The two most common are discounted cash flow and capitalization of earnings. There are other income approach methods. They are less commonly used than the two I've listed. The discounted cash flow method converts a stream of projected earnings or other benefit stream into present value by applying a discount rate. The earnings from each discrete period are discounted to present value, and then a terminal value is added to arrive at the total value. Here's the formula for the discounted cash flow. I know for any of you who weren't fans of math in school, it's going to look horrible, but this is what it's based on. Here's an example of why it works. Let's take a look at your savings account. If you were to put $1 into the bank today, and you had a 10% interest rate, and oh, if only we could get a 10% interest rate, but it's easy math. If you had a 10% interest rate, in 1 year your dollar would be worth $1.10. In 2 years, your dollar would be worth $1.21, and in 3 years, your dollar would be worth $1.33, i.e. compounding. Well, we can apply that same theory to the cash flows of your business. If you are estimating that in 3 years you will be making $1.33, reversing the process gets us to that $1.33 that you're making in 3 years being worth $1 today. It's the same idea, and once explained that way, it's pretty intuitive. Projecting earnings. This is always a question. None of us have a crystal ball. You just have good ideas and best guesses. So typically, the future performance of the company is estimated based on an analysis of historical performance and current and expected operating and industry conditions. There are various tools available to assist with this. The biggest is common sense and informed judgment. In general, we prefer, if we're going to use the discounted cash flow method, to use management's projections. We don't like to make the projections ourselves because even though our job is to become an expert in the business, it is you who knows your business better than anyone else. So what is the discount rate? As I mentioned, it's the rate of return or cost of capital necessary to convert a monetary sum, payable or receivable in the future, into a present value. The real question is, how do we come up with it? Well, more often than not, we use the weighted average cost of capital, which is based on the capital asset pricing model. We also occasionally use published industry standards. The weighted average cost of capital formula is pretty simple. It is the cost of equity times the percentage of equity in the capital structure of the business, plus the cost of debt times the percentage of debt in the business capital structure. Developing the cost of equity is a little bit more complex. This cost of equity formula that I'm showing you here uses information from the public markets. It's the rate of return for a risk-free security as of the valuation date, and typically we consider government bonds risk-free. A beta coefficient, which is based on volatility from comparable publicly traded stock companies. An equity risk premium for the market, which is generated by Duff & Phelps. They do a study every year that shows how the stock market performs versus risk-free markets. There are also risk premiums for size. The same Duff & Phelps study shows that smaller companies are riskier and therefore have a higher cost of capital. And then an adjustment for company-specific risk. You could also develop the cost of equity through a similar formula that uses published industry premiums rather than market betas. So how is it used? How is it put into practice? Well, we see here the risk-free rate on a 20-year Treasury bill, to which we've added an equity risk premium, a size premium for small size, and some company and industry-specific risk to get a total WACC or discount rate. If we were using the capitalization of earnings method, we would then subtract out long-term growth to get to a capitalization rate. So I just mentioned the capitalization of earnings method. What is it? Like other income approach methods, this is based on the principle that the value of the business can be estimated by the future benefits received from the ownership of the business. Future benefits of ownership are assumed to be reliably predicted by past performance. This means that this approach, this method, is only appropriate for companies in stable growth phases. How do you calculate the value, the present value, using the capitalization of earnings formula? Well, people like it because it's simple. You take the net cash flow you expect next year, and you divide it by the weighted average cost of capital less the long-term growth rate. It's a very, very simple formula. If you were to do a discounted cash flow and use stable growth in the discounted cash flow, you would arrive at the exact same conclusion that you get from the capitalization of earnings method. It should not, all else held equal, arrive at a different value. So to recap, the DCF is applied when future performance is not expected to be consistent or stable, and the capitalization method is applied when company performance is expected to be stable or grow at a stable rate. So this is probably what really interests you. What impacts value? In general, there are two types of things that impact business value. There are things external to your company, and you can't really change these. And there are things internal to your company that you can change and impact the business value. External factors that impact company value are whether your market is expanding or shrinking, whether you have a dominant market position or a challenged market share, whether or not there are barriers to entry, whether your industry is expanding or contracting, whether the economy is expanding or contracting, and whether or not there have been any consumer shifts in preference to or away from your products. To drive this point home, let's talk about the economy. Here are some multiples from a few industries that we've segregated into pre-recession, recession, and post-recession. There isn't really any difference in anything in these multiples other than market timing. And as you can see, things like eating places, restaurants, saw a sharp decline in market value, all else held equal, in the recession. And that decline has continued to this day. So there's been some market hesitance to continue to invest in restaurants. Things like schools and educational services. Pre-recession had a relatively high multiple. These are, by the way, price to sales or invested capital to sales multiples. During the recession, the multiple dropped sharply and has somewhat rebounded post-recession. So things like industry perception and economics and market perception are very important to the value of your company. Now that the bad news is out of the way, what are things you can do to impact the value of your company? Well, if you want to increase the value of your company, things like having organized and up-to-date financials, strong gross margins, projections of strong cash flow. And by projections of strong cash flow, I mean reasonably reliable projections of strong cash flow, sufficient working capital to support your operations, good systems and structures to transmit knowledge in place, and a cross-trained employee base. Things in your business that would decrease the value are declining sales, inconsistent yearly financial performance, unreported cash or off-balance sheet loans, a lack of key employees, and no formalized business and marketing plan. Now that we've talked about those things, the things you can change, let's talk about discounts for lack of control and marketability. It follows right along. Here's what you can change. Now let's talk about lack of control. As I mentioned previously, there are some levels of value. One thing I didn't touch on a whole lot is investment or synergistic value. Occasionally, you will find someone who's willing to pay more than the next market participant for your company because they bring synergies to the table. They aren't willing to pay a lot more, but they are willing to pay slightly more in order to gain those synergies. We then have control value. You then have a minority value, and then non-marketable minority value. As you can see, the value of the company declines as you go down those steps. Why does it do that? Well, for a couple of reasons. When you think about any business, the ability to control the business and convert it into cash are afforded value. That's true of any investment. The longer you as an investor are required to hold an investment, the more it may lower value. This is something you can see in the bond market. It's true for businesses as well. And there's some empirical data that supports that different levels of control and marketability have different values to market participants. So what sort of discounts and premiums are there? There are discounts for lack of control or premiums for control. There are discounts for lack of marketability. There are key person discounts. Occasionally, you can see discounts differ depending on the interest valued and the techniques used to establish the value conclusion. Why does control have value? Or why do people not want to pay as much for an interest in a business if they don't have control? Well, the answers to that are that people with control can hire and fire, distribute earnings or declare dividends, buy and sell assets, enter into contracts, liquidate the business, set strategic objectives and goals, set compensation and performance standards. These are all things that impact your return. With a lack of control in a closely held company, it implies you are at the mercy of a controlling owner. Therefore, substantial discounts may be necessary to attract an investor to purchase a minority interest in a closely held company. Where do we get data on our discount for lack of control? From a data source called the Merger-Stat Control Premium Studies. This is a study that shows how much over the market price is paid to gain control of a company. It looks at the price of a stock before and after the announcement of an acquisition or merger. There's a terrible, terrible misspeak. And it's got pretty intense depth. There's a lot of data in that database. So what's marketability? As I mentioned, it's the ability to convert an ownership interest to cash. The time required to do so, the time required to liquidate your interest, affects the level of marketability. There are other factors that can also affect marketability. These are distributions of earnings, active market or industry roll-ups occurring, whether or not there's a key person in the business who will stay with the business, the number and profile of owners, and restrictions on transfer of stock. We get our data on the discount for lack of marketability from a couple of sources. There are pre-IPO studies which compare the price of a company's stock before and after the announcement of going public, and from restricted stock studies which compare letter stock restricted from trading for a certain time period to its publicly traded counterpart. How are these discounts applied? They're applied sequentially. So if you have a marketable control value of the company of $5 million, the first thing you do is apply the discount for lack of control. At a 20% discount, you would see a discount of about $1 million on the equity price to get to your marketable minority value. Your discount for lack of marketability then, more at 30%, would be a further discount of $1.2 million, or to arrive at a non-marketable minority value of about $2.8 million. So as you can see, the combined discount isn't 50%, it's closer to 44% because the discounts are applied sequentially, not additively. Here's something else we're often asked. What are the adjustments to my financial data and why have you done them? One objective of financial statement analysis is to provide a financial picture that can be reliably used to estimate future performance. We don't adjust willy-nilly, we adjust for reasons. Historical financial statements may need to be adjusted for items that distort the picture of the true operating performance of the business. We also adjust to develop a starting point from which to predict future earnings, to present historical financial information on a normalized basis, to adjust for accounting practices that are a departure from industry or GAAP standards, to facilitate comparison of the company to itself, other companies within the same industry, or to an accepted standard, to compare capital structures of the company to that of its competition or peers, or to compare compensation with industry norms. What sorts of things do we adjust? Unusual items, non-recurring items, extraordinary items, non-operating items, items that are affected by changes in accounting principle, items that are not in conformance with GAAP, and occasionally, depending on the degree of ownership interest, whether or not the interest has control, we may adjust cash flows for that as well. I'm going to touch on a couple of these. Unusual items are events or transactions that possess a high degree of abnormality. They're unrelated to or only incidentally related to the ordinary and typical activities of the entity. Events or transactions that are not reasonably expected to recur in the foreseeable future are called non-recurring items. Extraordinary items are events or transactions that are distinguished by their unusual nature and infrequency of occurrence. Items must be both unusual and non-recurring to be classified as extraordinary. So what are examples of unusual, non-recurring, and extraordinary items? Strikes and other types of work stoppages are one. Litigation expense or recoveries. Uninsured losses due to unforeseen disasters like fire or flood. One-time realization of revenues or expenses due to non-recurring contracts. Or the gain or loss on sales of a business unit or business asset. Other things that could be adjusted for are discontinuation of operations. Say, for example, were you to cease a product line, or insurance proceeds received on the life of a key person or from a property or casualty claim. None of these are expected to be things that are ongoing business operations, and so they would be adjusted out to present a normalized picture of the financials of the business. Non-operating items, I'm not going to read this whole list, but it's here for you. Non-operating items are things that do not contribute to the revenues or profitability of the business. Changes in accounting principle, things like a change in the method of pricing inventory or depreciation. Changes in accounting for certain types of contracts, or a change to or from the full cost method of accounting in mining industries. We also adjust for nonconformance with GAAP, and here again there's a list that I'm sure I don't need to read all of for you, but it's here for you as a reference. It's quite a long list. So what do we base our adjustments on? We take a look at industry ratios, we look at market wage data, and we look at company historical data. We're going to touch on a couple of special topics. The first is goodwill, and I'm running short on time here, so I'm talking fast. What is goodwill? And I'm going to answer this one because there are two commonly used definitions of goodwill. The first is the bundle of all intangible assets of a company, and the second is the residual intangible value remaining after all identifiable intangible assets have been valued. Entity goodwill is goodwill that attaches to the business enterprise. Personal goodwill is the goodwill that attaches to a persona and personal efforts of an individual. Personal goodwill is generally considered to be difficult to transfer if it's transferable at all. That is a buyer of a business might not be able to transfer the goodwill to themselves, and they might not be willing to pay for it. Therefore, it's typically not part of the fair market value of the business enterprise. When does personal goodwill arise? Traditionally, it arises almost exclusively in the context of a professional practice owner. The line gets fuzzy in the commercial business arena, and personal goodwill in a commercial business might be more key person risk than actual personal goodwill. There are no generally accepted methodologies to divide goodwill into personal and entity components. However, there are a number of methods that are used, and it can depend on case or jurisdiction. These include the multi-attribute utility model, a with and without analysis, and an excess earnings model. There are quite a number of factors that impact the level of personal goodwill. These are listed here for you, and they're pretty intuitive. As you can see, there's a fairly long list. And finally, we're going to touch on a few divorce-specific valuation challenges, as this is one of the more common scenarios that owners of closely held businesses will need a valuation in. The biggest challenge in divorce-specific valuations is that valuation isn't taught in law school. Judges don't necessarily understand valuation theory, though some of them do. There is a lot of contradictory case law that proves this out. Therefore, in a valuation in a divorce scenario, the report needs to make the valuation theory and the intuition behind it crystal clear. It needs to be well supported and well written. Another challenge is there's a short window in which to obtain info. You need to anticipate all future info needs as part of the discovery process. Remember back when I talked about the valuation process, how there was some going back and requesting additional information? In a divorce process, that can be challenging. Basically, if you miss key info, you're out of luck. Therefore, it's pretty important to get someone who has got a good handle on the valuation process and the type of business that is being valued in order to request all of the appropriate info up front. There's also a problematic information flow for other reasons. The spouse may be unwilling to share info or actively attempting misdirection. There's an incentive to hide value. There's a perceived advantage to making a business look less valuable. This can be done by postponing signing contracts that guarantee business income or deferring follow-on rounds of financing. We sometimes call this the business shift syndrome, or BS, which is a sudden shift in business performance around the time of the divorce filing. The business owner can be trying to make the business appear less valuable. However, this could also be the result of macroeconomic or industry conditions, so careful assessment is necessary. In summary, as we wrap up here, valuation is a process that leads to an opinion of value. There are many scenarios in which a valuation is needed or helpful, and we've touched on quite a few of them. There are 3 approaches to value, but many valuation methods. And there's a wide variety of things you can value: invested capital, equity, or individual assets. And lastly, certain situations have special considerations to be aware of. We've by no means touched on all of them, but I think we've touched on the ones that you, as business owners, are most likely to see. And we have time for maybe 1 or 2 questions if anyone has any.
Right now we don't. We have been able to answer the questions. They were covered, or you ended up covering them. Am I coming through, Andy? Okay. So I think we can wrap up a little bit early.
Well, thank you all for joining us today.
Thanks, Theresa.
Any questions or comments? My contact information is there.
Thanks, Theresa. Thanks to the participants for joining us. Later today, you'll receive a follow-up email in probably an hour from now with a few survey questions that will help us target information for future webinars. Please take a couple of minutes to fill that out. For the attorneys online, the webinar qualifies for CLE. Watch for an email. We will be sending one out with some common answers to some common questions that we normally get on this topic. The webinar and slides will be posted online on our webpage, sgcpa.com. Again, for you to view again and to pass on to your colleagues. We appreciate your attendance and look forward to presenting a future webinar. Have a great day.